Hey there, Lincoln here from boacademy.org. Today I want to talk to you about my $187,000 growth portfolio. And we are going to walk through all of my stocks, and I'm going to give you a summary of why I'm investing in these companies and why I plan to hold them for the long term. On this channel, we preach long-term bullish investing by practicing the bull mentality. The bull mentality is that we know what we invest in. We understand what we invest in. We believe in what we invest in, and we hold for the long term because that's how we build wealth in this country. That's how we give ourselves the best chance of success on the stock market. So all of these companies I plan to hold for the long term. My default investment strategy is to just buy and hold because we've seen over and over again that yields the best returns over the long term. We don't day trade, we don't try to get rich quick. We just buy and hold for as long as we feel convicted in the companies that we invest in. So that's exactly what I do on this channel. And over the last year, over the last 18 months, I've grown my portfolio from $23,000 to over $187,000 in value. So that has been working out very well for me. If you've been watching this channel, boacademy.org, for the last few months, you would have seen my $66,000 growth portfolio back in July or August of this year, and my $107,000 growth portfolio back in October of this year. And now we're going to walk through my $187,000 growth portfolio, and you will see that not much has changed over the last few months. I just buy and hold. I practice what I preach. I'm not here trying to day trade. Over 95% or so of day traders end up with less money than what they started with. Swing traders also don't have a much better record than day traders. So I just do what I've seen the most successful investors of our time do and succeed. Warren Buffett, Mark Cuban, Charlie Munger, they invest for the long term. And another thing you will see in my portfolio is that I do not believe in over diversification. The money managers who want you to pay them to manage your money for you will tell you, oh, you need to diversify your portfolio so that you can be safe. Well, those people who are managing your money didn't get where they are. They didn't get ultra wealthy by buying the entire index. The only reason they're preaching to invest in the index and to be over diversified is because their job is to keep your money safe and then show you a little bit of growth so that you can keep paying them their fees to manage your money. That's their job, to make money managing your money and keeping it safe. So they're going to preach to you what they want you to hear, that you should be diversified, that you should buy the index because it's safe and you won't lose money, so that you can feel comfortable investing with them. But the truth is that most wealthy people didn't buy the entire index. They didn't buy hundreds of companies to get where they are. They bought a few companies that they believed in, were passionate about, and had great conviction behind. For years and years and over decades, they built up their wealth through the appreciation of the value of those assets. Because they are smart enough to know that if you buy the entire index, you buy the entire bucket, the great returns of the few good companies in that index will be dragged down by the bad returns, by the poor performance of most of those companies in that index because they are subpar. They don't perform as well as those top companies. So then what happens is you average your returns to the middle and you get mediocre results. You get 6% a year, you get 7%, you get 10% a year. That's safe, but it's not going to build you outsized wealth. And it's going to take you your whole lifetime to reach retirement. They know that. They know what they're doing. So on this channel, we practice bullish investing. That's what we do here. We find a few companies that we believe in and that we plan to hold for the long term, and we invest in them bullishly. We invest in them heavily, and then we benefit from that appreciation. You also won't see dividend stocks in my portfolio because dividend stocks, by definition, are not focused on committing all of their resources to growing the company even further. They are settling down. That's how dividend companies work. They take half their earnings and they give it to their shareholders because they know they don't know how to reallocate that money to grow the company. So if I'm giving my money to someone else and they're telling me, hey, I can't use this to grow your money for you, so here it is, you can have it back, then that should tell me that that's not the right place for wealth building. It might be great for wealth maintenance, to maintain my wealth, but not for building my wealth. I'm poor. I don't have wealth yet. So I gotta build that first and then I can go and maintain it with dividends, with an index fund. So my portfolio is about growth stocks. So I have 8 companies, just 8 companies in my growth portfolio, and we're going to walk through each of them. But before we get to that, I want to ask you a favor, do some housekeeping. If you enjoyed the video, like the video below, subscribe to the channel, hit the notification bell, and comment your thoughts below. Let me know what you think about my portfolio. Let me know if you're investing in any of them. Let me know which of these stocks you would like me to cover in greater detail. And let me know if you disagree with my investment strategy. If you don't think I'm being smart, I want to hear why. Comment below. And if you want to help the channel grow and reach more investors, join us over at patreon.bullacademy.org. You will get more access to me and get direct answers to your investing questions. And you will be able to engage in our Discord channel where we share the stocks and SPACs that we're all watching and investing in, and share resources to help one another grow our wealth together. And that's where I share early research into companies that I'm becoming very convicted in, so that our patrons can do their own research early on and get in if they want to, before everyone else finds out. And you will have a greater chance at winning $200 every month just for being a loyal and engaged patron. And you will have priority access to request videos that you would like me to do and companies you would like me to cover. So if you're interested in all of that, I hope to see you over at patreon.bullacademy.org. Thank you in advance, and let's hop in. So really quick before we hop into the first stock, I want you to know how I got the money that I started investing with. During college for about 4 years, I built a publication on marketing, and last year someone asked me to buy it, so I sold it to them and then put most of that money into the stock market. And of course, I'm a software engineer, so I use my salary to continue to invest into the market and to average into my current positions. So now that you know how I got started, let's look at my first stock. CIIC merger, CIIC, the SPAC taking Arrival public in Q1 of 2020. Arrival is a vertically integrated United Kingdom-based manufacturer of commercial EV vehicles, including buses and vans. Arrival, which is proudly staffed with over 500 software engineers, leverages its hardware, software, and robotics capabilities to build out vertically integrated solutions for its commercial customers. Furthermore, thanks to its modular components manufacturing system, the company can become a platform for other companies who want to use their components to build out their own solutions, to build out their own electric vehicles. Arrival, who manufactures sleek vehicles for their customers, has already signed contracts with total order value of $1.28 billion from companies including UPS. That's right, United Parcel Service. UPS has ordered 10,000 vans from Arrival with an option to purchase 10,000 more. Of course, this introduces the risk of concentration, with $1 billion of their signed contracts being accounted for by UPS alone. That isn't great, but it's a pretty good problem to have when UPS wants your vehicles before you produce them. And they already produced the prototypes for these UPS vehicles. They custom make all of their vehicles for their customers. And the way they can do that at scale is thanks to their unique manufacturing process and their vertically integrated system. They control the full pipeline. Thanks to their unique micro factories, they can build out 4 of these factories in existing warehouses each year, and each factory can produce 10,000 vans each year. And their process is enabled by components that can be assembled by robots. Furthermore, their manufacturing process is enabled by the elimination of welding and high-wage skilled labor. These micro factories have low capital expenditures, and they can rapidly scale. And Arrival is projecting that they can become cash flow positive in 3 years using these micro factories. That would be 30,000 vehicles produced to get to cash flow positive, which I think is well within reach, and the company again is already producing their prototypes. Their prototypes are functional, unlike some companies we've seen, and they're beautiful. I enjoy looking at them. On November 18th, a few weeks ago, one of my patrons at patreon.bullacademy.org told me about Arrival, CIIC, and asked me my thoughts on it. And after looking into the company, I became increasingly bullish on the company's future. And once I had enough information about it, I told my other patrons on our Discord channel that I was watching it closely, and then I started investing in it. I bought my first share on November 18th for $13.25. And that same day, I kept buying into it as it went down to $12.05. So I kept dollar cost averaging into the SPAC that's taken Arrival public in Q1 of 2021. And now I've invested $7,791 for 510 shares of the company at an average cost of $15.28. Like I said, I am thankful to my patrons for pointing this out to me. And once I had the information on it, I gave them my early research so that they could make their own decision too. And since then, since November 18th, my position is up 86%. So almost doubled my initial investment. And that brings my equity value to $14,484. This SPAC accounts for 6.28% of my portfolio. And the deal values Arrival at an enterprise value of $5.39 billion, which is 0.4 times its expected 2024 revenues of $14.1 billion. So of course, this company has not delivered their first commercial vehicle to their customers yet, but that should start happening in 2021. And I believe that this company will be a leader in this space, in this commercial EV space, with autonomy where it makes sense. So I'm going to continue to invest in this company long term and benefit from the appreciation of the value of this asset. Next up, Velodyne LiDAR Inc. Velodyne is the pioneer for 3D sensing for autonomous vehicles. Velodyne's technology enables cars and other vehicles to detect the objects around them as they drive on the road or on sidewalks. And their modular components can be installed on cars and on robots that deliver food to people's homes to enable them to detect the world around them in order to drive autonomously. Velodyne merged with Graph Industrial, the SPAC, in Q4 of 2020 to become a public company. I started investing in the SPAC back in July of 2020, and I've invested about $6,500 to acquire 600 shares at an average cost of $15 per share. My position is currently up about 10%, which brings my equity stake to $9,138. With a market cap of $2.55 billion, Velodyne LiDAR accounts for about 4% of my portfolio. Velodyne was the first pure-play LiDAR company on the market, and they are the clear leader in this space, so I plan to hold this one for the long term and benefit from the appreciation of the value of this asset as more investors realize how valuable this company can become, and as the EV and autonomous driving markets continue to ramp up. Next up is Tattoo Chef Inc., TTCF, the plant-based frozen foods company. Tattoo Chef merged with Forum Merger 2, the SPAC that took it public, back in October of 2020. And just a few weeks ago, I had a chance to interview the CFO of the company on this channel on boacademy.org. And if you haven't seen that interview yet and you're interested in Tattoo Chef, you should go watch that interview because we learned a whole lot about the future of the company and what they plan to do to grow the company going forward using their all-new marketing plan and investments in automation in their manufacturing factories. Tattoo Chef's supply chain is vertically integrated, which means that they do not have to wait on partners to produce their innovative plant-based offerings for their customers. So Tattoo Chef has a lot of growth ahead of it, but the stock has been trading sideways for the last couple of months. If you go to our channel at boacademy.org, you will see that we've covered this company a great deal. So if you're interested in learning more about that, go check out those videos. Now let's look into my position. Between June 5th and June 19th of 2020, I invested $14,500 into FMCI, the SPAC that took Tattoo Chef public, for 1,000 shares of the company. And now I own those 1,000 shares of Tattoo Chef Inc. And all of that was at an average cost of $14.50 per share. I'm currently up 10.27% on this position, which brings my equity value to $16,000. With just over $1 billion in market cap, Tattoo Chef Inc. accounts for 6.94% of my portfolio. If you don't know this yet, and despite what all the swing traders say, Tattoo Chef has great revenue projections and they have great revenues today. And they have more revenue than Beyond Meat when they went public. And they have control over the supply chain, which most brands cannot say. So I believe in this company and I will continue to hold it so long as I don't see any reason to lose my conviction. And after my interview with the CFO a few weeks ago, I feel even more confident in the company's future. Next up, Upwork, the leading online freelancing marketplace. Upwork enables anyone in any business to go online and find a freelancer to hire, to work on a project for them. And that project can be one time or ongoing. And Upwork helps both sides manage the process. They include ways to find talent and then also to pay that talent in a secure manner. So Upwork is a middleman between people who want to get work done and people who want to get paid to do that work. And Upwork benefits when both sides succeed. Furthermore, it's becoming more and more clear that remote working is going to be a big part of our futures, and Upwork enables that for businesses and for those workers who want to work remotely. And the pandemic has shown just how valuable Upwork can become. I started investing in Upwork on November 22nd when I realized that the stock price was way down due to other investors being fearful when the company was going through a restructuring of their business. So I went in and I bought the company because I realized that the company was not fundamentally different from what it was before. They were just reorganizing their business. So understanding that this was not a big deal, despite their earnings going down for a couple quarters, I decided to buy into the company heavily. And I invested $6,280 for 550 shares of the company at an average cost of $11.42. Due to recent growth during the pandemic, my position is up 180%, which brings my equity stake to $17,600. With a market cap of $2.42 billion, Upwork accounts for 7.63% of my portfolio. 71% of analysts rate Upwork a buy and 29% rate it a hold. So all the analysts say that Upwork is a buy and hold. None say that it's a sell. 2 years in as a public company, I believe that Upwork is just getting started. The remote working transition has been sped up due to the pandemic, and many in the workforce have realized how convenient it is to work from home, and companies are seeing cost savings on offices. They don't have to pay for offices if everyone works from home. So remote working is here to stay. All that's left to figure out is just how many companies will continue to engage in remote working after the pandemic has passed. But either way, the freelance market will continue to grow. And as that grows, Upwork will continue to lead the market, and I will benefit for being a long-term investor in this company. Okay, we're halfway there. If you're enjoying this video, remember to like the video below, subscribe to the channel, hit the notification bell, and comment your thoughts below on the stocks that we've covered so far. And if you want to help the channel grow, join us over at patreon.boacademy.org to get more access to me and get direct answers to your investment questions, as well as know the stocks and SPACs that I'm watching and what we're all discussing in our Discord channel. Now let's continue to the next stock. Next up, IPOB Opendoor. IPOB is the SPAC by Social Capital and Chamath Palihapitiya taking Opendoor public. And they believe that Opendoor is their next 10x opportunity. And given Chamath's history and record, I tend to believe him when he says that Opendoor is a great company and has vast potential. Opendoor is the leading e-buying company that buys houses from homeowners, all with an online process. A homeowner can go online sitting on their couch and fill out a form telling Opendoor about their house, and within a day they can get a competitive cash offer from Opendoor for their house. And within 3 days, they can be out of their house with the cash in hand, and Opendoor owns the house now, and from there Opendoor can fix it up and then flip it by selling it to somebody else and profiting on the margin between where they bought it and where they sold it. So that's pretty much Opendoor's business model, but of course there's so much more to discuss on the company and how they plan to make even more money than what they currently are. But before we get into that, let's look into my position. I started investing in Opendoor on September 20th when it was at $13 and $12 per share, and I bought in consistently and averaged up and averaged down. So I bought them at $13, $12, $16, $20, and even $25 per share. Over the last few months, I've invested $17,000 for 1,100 shares of the company at an average cost of $15.49. My position is currently up 43%, which brings my equity value to $24,400. IPOB, the SPAC taking Opendoor public in Q4 of 2020, accounts for 10.58% of my portfolio. And the SPAC deal gives Opendoor an enterprise valuation of $4.7 billion, which is about 1x their 2019 revenues. In 2019, Opendoor sold over 18,000 houses to bring in $5 billion in revenue, and they have a plan to get to $20 billion and even $50 billion in revenue within the next decade or two. The company has been on record saying that they could become profitable whenever they choose to, but they are currently focused on aggressively acquiring more market share around the country and offering vertically integrated services that homeowners need, such as home warranties and home repairs. So this company is vertically integrated, which is one of 4 key points of my investment criteria. Opendoor is a long-term hold for me because this company has a clear path to domination in the future, and they already dominate all of their competition, including Zillow and Redfin. Their next 4 closest competitors don't even combine to meet their revenues from 2019. And if the company can continue to lead in their machine learning algorithms that offer homeowners competitive rates, then I don't see any reason that domination slows down. Next up is Jumia, the Amazon of Africa. And as it's becoming more and more clear, they are also the PayPal of Africa going forward if they can get their other business to succeed, which is showing early signs of doing. We'll get into that more, but let's look into my position first. Jumia IPO'd in 2019, and I started buying a company this June of 2020. And my first few purchases were for $5 per share. So I started investing in this company when it was at its lows. And since then, I've kept buying in and averaging up and averaging back down. So I bought in at 5, I bought in at 11, I bought in at 20, and 30, and 37. So that's how I invest. I just buy and I hold and I average in, going up or down on a consistent basis. Over the last 6 months, I've invested $9,300 for 800 shares of Jumia at an average cost of $11.64. My position is currently up 170.74%, which brings my equity value in Jumia to $24,200. With a market cap of $2.56 billion, Jumia accounts for about 10.93% of my portfolio. The company continues to show a path towards profitability, so analysts have rated Jumia at a 43% buy and 43% hold and 14% sell. So most analysts say that Jumia is a buy and a hold. Because Jumia is in the emerging market of Africa, it has added risk. Emerging markets bring on more risk, but also more rewards if they work out. So that's why I'm investing heavily into Jumia, because I believe that over the next decade, over the next 2 decades, Jumia will be the Amazon of Africa. They will lead the way for the e-commerce revolution on the continent. And that is what most other investors see in the company. But Jumia is not satisfied with only being the Amazon of Africa. They want to be the PayPal of Africa. They are building out their own payment platform that works much like Amazon for African businesses. They call it Jumia Pay, and it's working out very well. It's showing signs of being an incredibly profitable business. But Jumia is not stopping there. They are also building out Jumia Logistics. They are going to enable other businesses that are not on their platform to leverage their expertise in logistics to deliver their packages to their own customers. And Jumia gets paid for that service. So Jumia is building out an entire platform, an entire ecosystem for the e-commerce and logistics future of the African continent. And I want a big piece of that. So I'm going to continue to buy into this company. So my last 2 portfolio videos, I told you that Jumia was down due to a scandal after its IPO and investors questioning just how much of an African company Jumia is. And I also have that question. But Jumia has rebounded and done so exceptionally. Their stock price was as low as $2 per share in March of 2020, and this month it's been as high as $40 per share. So the company continues to grow and investors are buying into the stock more now. The hype has arrived for Jumia, but it's not just hype. This company is fundamentally sound, and if they can continue to drive the infrastructure in Africa to build out the e-commerce presence on that continent, my homeland, then they will continue to benefit from that. And investors who get in early and continue to hold for the long term will be rewarded hand over fist. So why do I plan to eventually go back home to Liberia, Africa to build up a business there? Until then, I'm going to continue to invest in Jumia and build my wealth and then use that wealth eventually to build my own companies in Africa. And I plan to hold this company without thought. I don't care about the price target. I'm just going to continue to hold it because if this company does well, any price target that's given today will be conservative to what the company will actually achieve in the future. Next up is Net, Cloudflare. Cloudflare is the leading web infrastructure and web security company out there. Cloudflare IPO'd in 2019, and that's when I began investing in the company because I, as a software engineer, as an entrepreneur who builds his own platforms, using Cloudflare for my security and for parts of my web app infrastructure, believe that Cloudflare is going to continue to lead this space, continue to lead this market, and dominate it. Over the last few months, Cloudflare has fluctuated between my first and second top company because their share price surged from $15 per share before the pandemic to over $70 per share today because they enable many internet companies that we all depend on during this pandemic and regardless of what happens after. These internet companies are here to stay, and Cloudflare enables all of them, so they will continue to grow as their customers, these dominant internet companies, continue to grow their revenues. So as the internet tech companies grow, Cloudflare stands to benefit from that. And that's the kind of company I like to invest in. Companies that enable other companies, that enable other people to succeed. Because when they succeed, then my company succeed. Cloudflare is a platform just like many companies you will see in my portfolio. I've invested $24,700 for 680 shares of the company at an average cost of $36.34. My position is currently up 111.89%, which brings my equity in Cloudflare to $52,360. With a market cap of about $24 billion, Cloudflare accounts for 22.7% of my portfolio. Market analysts have given Cloudflare a 73% buy rating and a 27% hold rating. That means that every analyst has looked at Cloudflare and said that they are a buy or a hold. None of them have said that Cloudflare is a sell. As a leading web infrastructure company, Cloudflare provides content delivery network services to its customers, among other services. And as a web security company, Cloudflare protects its customers' websites from DDoS, denial of service attacks, and they provide other internet security services as well as distributed domain name server services. And of course, they do a lot more. They provide a whole package to help their customers run their internet companies with peace of mind. So again, Cloudflare is a long hold for me, and this company is just getting started as well. They're only a year in as a public company. So I see a great amount of growth for this company going forward, and the pandemic has made that clear. And last but not least, SBE Switchback Energy, the SPAC taking ChargePoint public. ChargePoint is the leading EV charging network in the world. They have over 100,000 charging ports around the world, mainly in the United States and Europe. And they plan to start aggressively expanding further into Europe in the coming years. Before I tell you more about ChargePoint, let's look at the numbers of my position. I've invested over $30,500 for 2,100 shares of SBE, the SPAC, which will become ChargePoint once the merger is complete in Q1 of 2020. My average cost was $14.40, and Switchback Energy accounts for 30% of my portfolio. My position is currently up 132%, and I currently have an equity value of $70,800 in the company. This SPAC deal values ChargePoint at $2.4 billion in enterprise value. ChargePoint is an electric vehicle infrastructure company, and as I mentioned before, they operate the largest online network of independently owned EV charging stations operating in 14 countries, and they also make the software technology that's used in the chargers. So that means that their business model is that they sell their hardware, their charging ports, to businesses and entrepreneurs to build up their own charging stations. So they get paid for that hardware one time, but then they also continue to get paid for the software that enables that hardware to continue to operate. And of course, they also charge you service fees for maintaining that charging station and for customer service to help drivers figure out how to use the charging stations. ChargePoint has over 4,000 commercial customers, and 62% of the Fortune 50 companies, including Google, LinkedIn, and General Motors, are using ChargePoint. And more companies are signing up each day. Verizon continues to build up their charging stations at their corporate offices around the US. The reason I am so bullish on ChargePoint is because they are the ultimate pickaxe for the EV future, for the electric vehicle future that we all are moving towards. And ChargePoint's revenue growth is directly related to how much EV penetration happens over the coming decade. So the more EV cars we see on the road, the more ChargePoint stands to earn in revenues. No matter which EV car customers have, they can charge their cars using ChargePoint's chargers on the road and at home. Even Tesla cars can be charged using ChargePoint's chargers. So ChargePoint is basically the index for the EV industry. When I first bought SBE Switchback Energy on October 1st for $16 and $14.28, I thought the company was undervalued then, and I still think it's undervalued now at $30 per share. Over the last few weeks, the stock has reached as high as $37 and is now back to $33. And I still think we're at the ground level. Within the next 6 years, ChargePoint plans to grow its revenues from where it stands today at $135 million to over $2 billion. And that's going to be driven by its software business, ChargePoint as a service. They plan to grow the recurrent software and services revenue to half of their revenue. Today, it's only a fraction of their revenues. So the key to revenue and profit margin growth for ChargePoint is building up the recurrent software revenues. If they can continue to build up their recurrent software business and drive up that portion of the revenue, they stand to be incredibly profitable in the future. That's what I'm investing in. So I'm extremely bullish in this company and I plan to hold it for the long term. So those are all of my companies in my growth portfolio. I have 8 companies in this portfolio that I'm investing in bullishly and for the long term. If you do the math, you will see that my top 2 companies account for more than 50% of my portfolio. And my top 4 companies account for 75% of my portfolio. So I believe that this is how you build outsized wealth, by investing in a few companies that you are passionate about and that you believe in and that you plan to hold for the long term. So as I mentioned in the start, there are no dividend stocks in my portfolio. There aren't 100 companies in my portfolio so I can be diversified. I just invest in a few companies that I plan to hold for the long term, and that has shown great success over the last 18 months, starting with $23,000 and getting to $187,000 in portfolio value in less than 18 months. So the money managers out there might tell you that I'm doing something wrong, but if you ask their clients about their growth, you will probably get less than the S&P 500. You will probably get mediocre results. I don't want mediocre results, so I don't invest in the whole index, because by definition, you're going to get average. That's how it works. You get the top and you get the bottom, and then you get the middle. That's just math. So I pick a few companies that I know, understand, believe in, and plan to hold for the long term, and I invest in them heavily. That's it. That's my whole strategy. So it's really not that complicated. I haven't done anything special here. I've just gone against the conventional wisdom. Remember, the majority is always wrong. There's no wonder why most people in developed nations are poor. Because most people do what most people do, and they get the results that most people get. I don't want those results. I knew going in that I wanted better. I've always gone against the grain. I've always been contrarian. And that's how I got where I am. So I will always continue to think for myself and always question conventional wisdom. And I implore you to do the same. Don't just listen to the guys on TV, on CNBC, telling you that you can't manage your own money and that you're not smart enough and that you're doing it wrong and retail investors are dumb. Because at one point, they were also retail investors if they weren't trust fund babies, but that's neither here or there. But they didn't get to where they are by investing in the entire index. Even Warren Buffett says it. Anyone can invest all of their money into the S&P 500 and get mediocre results, get the average. But if you want to build outsized wealth and retire earlier than most people do, which is late into their 60s, then you have to make up your own mind and make your own decisions and invest in a few companies that you know, understand, believe in, and plan to hold for the long term. For me, that's between 5 and 10 companies. For you, it might be between 10 and 20. But it should never be 100 companies unless you just don't have the time to read a few news articles every week to keep up to date on your companies. That's all I do. I read the news. It's pretty simple. I wake up, read the news, and then keep living. That's it. The chances of all of your companies that you pick failing is pretty slim. Even when they do, I've had a company go from $50 per share one month to $5 per share the next month. And I'm still here. Even through that scandal, even through a pandemic, I am still here. So the point of all of this is not to brag. What I want you to know is that you can do it too. It's not as hard as the money managers and the people on CNBC make it out to be. They want you to believe it's hard because then you'll go to them and let them manage your money for you and pay them 3% in fees just to get you mediocre results. So let me hop off my soapbox and say thank you for watching this video. If you enjoyed it, like the video below, subscribe to the channel, hit the notification bell, and comment below what your thoughts are on my portfolio or my strategy, and which companies you would like me to cover more in greater detail. And if you want to help the channel grow and reach more investors and get more access to me and get direct answers to your investing questions, then join us over at patreon.bullacademy.org. You'll be able to engage in our Discord channel where we share resources to help one another grow our wealth together and discuss the SPACs and stocks that we're all invested in. And of course, I share early research into companies that I become bullish on. And you will have a chance at winning $200 every month just for being a loyal and engaged patron. So if you're interested in all of that, I hope to see you over at patreon.bullacademy.org. And whatever you do, remember to always practice the bull mentality. The bull mentality is that we know what we invest in, we understand what we invest in, we believe in what we invest in, and we hold for the long term because that's how we build wealth in this country. That's how we give ourselves the best chance at success on the stock market. So I plan to hold these companies for the long term and benefit from the appreciation of the value of these assets. I'm Lincoln with bullacademy.org. Thank you again and have a great day.